In 2026, the United States national debt explodes past $37 trillion, and interest payments alone are about to swallow nearly $1 trillion each year. Why America is running out of money isn't just a headline. Families face rising mortgage bills, businesses see loans balloon overnight, and government cash is running dangerously low. But what invisible choices and hidden pressures brought the world's richest country to the edge of a fiscal cliff? And how close are we to a financial breaking point? The answer starts with the crisis habits that rewrote the rules of American spending. In the fall of 2008, the U.S. Treasury and Congress authorized an unprecedented rescue, the Troubled Asset Relief Program, known as TARP. With more than $700 billion approved almost overnight, the government bought up toxic assets and injected capital into the banking system. What began as a one-time response to crisis quickly set a new template. Emergency spending, once rare, became the default tool for managing shocks. Over the next decade, deficits never returned to pre-crisis lows. Instead, the federal government kept borrowing to fill budget gaps, even as the economy recovered. In 2017, Congress passed a sweeping tax overhaul that slashed corporate rates and cut individual taxes. The Tax Cuts and Jobs Act promised to boost growth, but it also reduced federal revenue by hundreds of billions of dollars each year. Unlike previous eras, these tax cuts were not paired with major spending reductions. The result was a growing gap between what the government spent and what it collected. By the end of the 2010s, trillion-dollar deficits were no longer an exception. They were becoming routine. The habit of reaching for bailouts and tax relief without matching savings locked in a new era of permanent shortfalls. The arrival of the COVID-19 pandemic in early 2020 triggered a wave of emergency spending, unlike anything in modern U.S. history. Congress passed a series of relief bills, including the CARES Act and the American Rescue Plan, with a combined price tag surpassing $5 trillion in just over a year. Direct payments landed in millions of bank accounts, expanded unemployment checks kept households afloat, and businesses received forgivable loans to prevent mass layoffs. The federal deficit soared to record levels, but with interest rates at historic lows, borrowing seemed almost painless. Treasury auctions cleared easily, and the cost of servicing new debt barely moved. That sense of ease did not last. By late 2022, inflation began to surge, and the Federal Reserve responded by raising interest rates at the fastest pace since the 1980s. The government, still running elevated deficits, now faced a new reality. Every dollar borrowed came with a much higher price. Between 2022 and 2026, the average interest rate on federal debt more than doubled, pushing annual interest payments toward $1 trillion. The legacy of pandemic stimulus collided with a new era of expensive borrowing, setting the stage for a budget squeezed by both past promises and rising costs. The numbers in 2026 leave little room for doubt. The U.S. national debt stands at $37.85 trillion, a figure that has swelled by more than $2 trillion in just 12 months. Each new dollar borrowed comes at a higher price, as interest rates on government debt have climbed sharply since 2022. This year alone, the federal government will pay nearly $1 trillion in interest, more than any other discretionary program, and second only to Social Security across the entire federal budget. Annual deficits remain stubbornly high, sitting between $1.7 and $1.8 trillion, or around 5 to 6% of GDP. These shortfalls are not just accounting entries. They represent the gap between what the government collects and what it spends year after year. The result is a debt burden that now matches or even exceeds the size of the entire U.S. economy. A closer look at the budget reveals how quickly interest costs are crowding out other priorities. In 2015, net interest payments made up about $223 billion. By 2026, that figure has more than quadrupled. Nearly 1 out of every 6 federal dollars goes just to pay the interest on past borrowing. The Congressional Budget Office projects that interest will soon surpass Medicare as a share of federal spending, making it the second largest line item after Social Security. With about $9 trillion in Treasury debt maturing this year alone, the government faces a massive refinancing bill. Much of this debt was issued at far lower rates, meaning the cost to roll it over will be far steeper. These headline figures are more than just warnings. They are the hard limits shaping every debate about taxes, spending, and the future of the American budget. Mandatory programs. Federal spending today is dominated by commitments that Congress rarely revisits. In 2026, more than 70 cents of every federal dollar is locked into mandatory programs: Social Security, Medicare, Medicaid, and interest on the debt. These are not annual decisions. They are built into law, growing automatically as more Americans retire and healthcare costs climb. What is left? Defense, education, transportation, research, and everything else must fit into an ever-shrinking slice of the budget. Discretionary spending, once the main arena for political debate, now accounts for less than a third of total federal outlays. Interest payments. The pressure from rising interest payments has made this squeeze even tighter. Net interest, which hovered below $250 billion a decade ago, is set to cross $1 trillion this year. That single line item now rivals or exceeds what the government spends on Medicare or the entire defense budget. The pie chart for 2026 tells a stark story. Social Security remains the largest piece, but interest payments have overtaken Medicare, pushing essential programs further to the margins. Maturity wall. Behind these numbers sits a looming challenge. About $9 trillion in Treasury debt comes due this year. Much of it was borrowed when rates were low. Now every dollar rolled over is subject to sharply higher costs, locking in bigger interest bills for years to come. This maturity wall means the government must find buyers for record volumes of new and refinanced debt, often at yields above 4.5%. If demand falters or rates rise further, even more money will be diverted from public services just to keep up with past borrowing. Fiscal environment. The budget's composition has quietly redrawn the boundaries of what is possible. As mandatory spending and interest devour more of each tax dollar, the space left for new investments, or even basic upkeep, continues to shrink. The result is a fiscal environment where choices grow harder, and the impact of every cut or delay lands closer to home. On a quiet street in Columbus, Ohio, the Shriver family sorts through a stack of bills at their kitchen table. In January, their adjustable rate mortgage reset, jumping from 4.3% to 6.9%. The monthly payment leapt from $1,340 to $1,677, an increase of $337 overnight. For a teacher and a nurse, that difference is the cost of groceries for the month or the summer camp their daughter begged to attend. The new mortgage statement arrived in May, followed by a flurry of text messages. We need to cut back again. In their bank records, savings that once offered a buffer now shrink, eaten away by higher debt payments and rising prices at the store. The family's budget spreadsheet shows fewer meals out, no vacation, and a growing list of things to postpone. New tires, a birthday party, even routine medical visits. On April 18th, a diary entry reads, "Felt helpless. Budget shrinks as prices rise. Worried about summer bills." For the Shrivers, the national debt crisis isn't an abstract debate in Washington. It's the sharp edge of reality, slicing into daily life, one payment at a time. A few blocks from downtown Phoenix, a cafe owner unlocks the front door before sunrise, bracing for another day of hard math. In 2023, she refinanced her small business administration loan, locking in what seemed like a manageable rate. Now, the monthly payment is up 35%. The bank's letter, stamped June 2026, spells it out: higher rates, no room to negotiate. At the same time, the cost of coffee beans and flour, her two biggest inputs, has jumped 20% since last year, driven by global supply shocks and a stronger dollar abroad. The cafe's revenue holds steady, but expenses are up 18%, squeezing margins to the thinnest they have ever been. By midsummer, her line of credit application is denied. Lenders are tightening, wary of the broader economic climate. She lays off 2 staff members, apologizing over the counter. Her decision isn't just about payroll. it's about survival. For small businesses like hers, the cost of debt and basic supplies is now a direct threat to jobs and local economies. On Main Street, the fiscal crisis isn't a headline. It's a daily calculation with real consequences for workers and owners alike. Congress faces a menu of hard choices, but agreement is elusive. Three main levers dominate the debate: cutting spending, raising taxes, or reforming entitlements. Each option comes with powerful opposition. Social Security and Medicare, which together account for more than half of all federal outlays, are protected by senior advocacy groups with deep pockets. In 2025 alone, AARP and affiliated organizations spent over $90 million on lobbying, blanketing Capitol Hill with ads warning against any reduction in benefits. Attempts to raise the retirement age or trim cost of living adjustments have consistently stalled after grassroots campaigns flooded lawmakers' offices with calls and emails. On the revenue side, closing high-income tax loopholes is often discussed as a partial fix. The math is clear. Estimates from the Tax Policy Center show that eliminating the most generous deductions and offshore shelters could generate up to $300 billion per year. Yet well-funded coalitions representing high earners and corporations poured more than $110 million into lobbying efforts last year, successfully defending targeted breaks in the most recent budget deal. Extension of the 2017 tax cuts remains a political flashpoint, with moderate lawmakers under pressure from both business groups and constituents worried about take-home pay. Expert voices highlight the narrowing window for action. Jason Furman points out that deficits are now driven by a blend of automatic entitlement growth and tax relief, warning that unchecked interest costs will soon crowd out even more of the budget. Maya McGuinness argues that without phased reforms to Social Security and Medicare, trust funds could run dry within a decade, forcing abrupt cuts or steep tax hikes. Stephanie Kelton, by contrast, warns against austerity, suggesting public investment can still yield long-term returns even as deficits grow. William Gale breaks down the arithmetic. Closing loopholes alone will not solve the problem. But without new revenue, every dollar cut from discretionary programs means less for schools, roads, and research. No single path offers an easy fix. The debate is gridlocked, shaped by lobby spending, election pressures, and the looming deadlines of trust fund depletion. As Congress weighs each lever, the urgency grows. The outcome will determine what remains possible for the federal budget and what gets left behind. In late 2025, the Federal Reserve made a quiet but consequential move. It paused its program of quantitative tightening, halting the steady runoff of government bonds from its balance sheet. The decision followed weeks of mounting stress in short-term funding markets, as banks and investors struggled to absorb a flood of new Treasury bills. Overnight lending rates spiked, signaling that liquidity was drying up faster than policymakers anticipated. The Fed's balance sheet, which had been shrinking for 3 years, stabilized as officials shifted to reinvesting maturing securities rather than letting them roll off. Behind closed doors, central bank officials debated how far they could push the system without triggering broader instability. Minutes from the December meeting reveal a growing sense of caution. One governor warned that further reductions in reserves could risk disorderly conditions in funding markets. The timing was daunting. With $9 trillion in federal debt maturing in 2026, the Treasury faced a daunting refinancing challenge. Most of this debt had been issued at much lower rates. Rolling it over at current yields would lock in hundreds of billions in extra interest costs. The Treasury needed a smooth market for its auctions, but the Fed's efforts to tighten policy were straining that very system. In public statements, the Fed insisted that its primary mandate remained price stability, not debt management. Yet the line between monetary and fiscal policy was growing thinner by the month. By March 2026, internal communications between the Fed and Treasury reflected growing friction. Treasury officials pressed for more support, warning that market volatility could drive up borrowing costs even further. Federal Reserve leaders, for their part, resisted calls to ease policy, arguing that a premature pivot could reignite inflation. The feedback loop was clear. Higher rates meant higher interest payments, which widened deficits, fueling more debt and putting new pressure on the Fed to intervene. Each decision carried risks, not just for Wall Street, but for every household and business that depended on stable credit and predictable prices. The stakes of this institutional balancing act were no longer theoretical. They played out in real time, with every auction, every rate decision, and every headline about America's finances. Global markets. Financial tremors in Washington rarely stop at the water's edge. In May 2026, as U.S. Treasury yields spiked above 6.5%, the effects swept through global markets in a matter of days. Investors, spooked by the rising cost of American debt and fresh warnings from the International Monetary Fund, began pulling money from riskier corners of the world. The Bank for International Settlements issued a bulletin. Funding costs for emerging market governments were climbing fast, as global lenders demanded higher returns to offset new uncertainty. Borrowing costs, sovereign bond spreads in developing economies widened sharply. In Argentina, the risk premium on government debt rose by more than 1 percentage point within weeks, echoing previous episodes when U.S. fiscal stress triggered capital flight. Other countries felt the pressure too. Turkey and Kenya each saw their borrowing costs jump by 50 to 100 basis points, according to market analysts tracking the J.P. Morgan EMBI index. These numbers may sound abstract, but for finance ministers in Buenos Aires or Nairobi, they translate directly into higher interest payments and tougher budget choices. Dollar's strength. Currency markets lurched as well. The dollar's strength, fueled by higher U.S. yields, made it harder for other countries to service dollar-denominated debt. Local banks in several emerging markets scrambled to shore up reserves as capital flowed out. Some governments delayed infrastructure projects or cut public spending in response, hoping to avoid a broader crisis. The International Monetary Fund's latest report called the U.S. debt situation a systemically important risk, warning that further volatility could threaten financial stability far beyond American borders. No longer. For global investors, the message was clear. America's fiscal troubles are no longer a domestic affair. A single week of Treasury market turbulence can ripple outward, driving up borrowing costs for dozens of countries and raising the risk of financial stress in regions already stretched thin. The world's reliance on U.S. debt as a safe asset means that every policy decision in Washington now carries consequences for budgets, currencies, and economies across the globe. In 2026, the U.S. national debt stands at nearly $37.85 trillion, with annual interest payments approaching $970 billion. Figures confirmed by Treasury reports and Congressional Budget Office forecasts. Over $9 trillion in federal debt is maturing this year, forcing the government to refinance at higher rates and putting unprecedented pressure on the federal budget. Decades of emergency stimulus, tax cuts, and unchanged entitlement programs have turned temporary measures into permanent deficits. While policymakers debate reforms and the Federal Reserve balances inflation with stability, there is no consensus on how to restore fiscal health. Some budget documents remain classified, and the long-term impact of these decisions on households, businesses, and global markets cannot yet be fully measured. What remains clear is that the choices made since 2008 have left America with fewer options and greater risks. The question now is not how the crisis began, but whether the nation can chart a sustainable path forward from here.